I think if America returns to free market and free speech, yes, it will be and remain the strongest country and also will lead further into the 21st century. If it takes the other way, I think the Chinese know better how to run a dictatorship.
Welcome to the Jay Martin Show. If you're new to the show, my name is Jay. I'm an investor. I'm here looking for the smartest home for my cash. If that sounds like you, then I think you're going to like what we do here. My guest today is Florian Grummes, the founder of Midas Touch Consulting. Florian is an investor and money manager. Fascinating conversation today. We started by talking about where he's allocating capital and why, and then segued into the geopolitical landscape and how that is impacting his investment thesis and general global outlook. Always interesting catching up with Florian. Right before we jump in, if you are curious about building a portfolio in the commodity sector, maybe you've noticed that the smart money is no longer chasing overvalued tech stocks and it's beginning to invest in the raw materials that the world needs on the back of deglobalization and resource scarcity and uncertainty, then you're going to love The Commodity University. Check out thecommodityuniversity.com. This is a 10-chapter course led by myself. I'm joined by many friends like Rick Rule from the sector, many other analysts and investors, and we guide investors through a 10-chapter course on building a portfolio in the commodity sector, what to pay attention to, what to avoid, what gets investors in trouble, all of this stuff. So check out thecommodityuniversity.com. Now here is Florian Grummes. Enjoy. All right, here I am with Florian Grummes. Florian, it's great to see you, and thanks for coming on the show today.
Thanks, Jay, for having me again. Pleasure to be here.
Well, I'm looking forward to chatting with you. Let's start with the high-level question, just to get a sense of where your head's at, and then I'll just pull on threads. What is your, main macro outlook right now? How are you viewing the world, and what are you paying attention to?
Oh gosh, I mean, there's a lot of stuff to pay attention to. Obviously, this week it's been the gold price, but in the bigger picture, well, actually, the gold price plays probably an important role in the big picture as well. So, which is of course West against East, US against China, the dollar, the falling interest rates as of the last 4 weeks. I mean, the 10-year yields came down 18%, I think. I think the market is pricing in some form of a rate cut sooner than later at the moment. And at the same time, I still expect rather a crash landing. While looking at the stock markets, especially the German DAX, for example, is a new all-time high. It doesn't make sense, given that there's an official recession going on in the country. So, a lot of confusing data to bring it together. And basically, the answer to all this is, again, the crack-up boom. So, a weird kind of mix of things happening that in the end of the day leading to more loss of confidence into the financial system and into the dollar and into the currencies, and people escaping in whatever hard types of assets. And this can be obviously also Bitcoin, which is also had a nice run over the last days. So it's a very tricky, challenging picture at the moment, because you have the feeling like it can break everything immediately, highly unstable. And yet at the same time, stock markets are doing really well since the end of the typical autumn correction. And gold had a crazy run up on Monday, and a big reversal down $120 from the top intraday. So, there's a lot of stuff going on, and it doesn't necessarily fit all together.
So actually, let's start with the idea of the crack up boom. Can you elaborate on that concept for me a little bit?
Yeah, basically it says that on the one hand, central banks and governments have to create so much money out of thin air just to keep the system going. It's a fiat system, a fiat money system, backed by nothing than thin air promises and in the best case military, right? And we've seen this in the past over and over again. So at some point, they have to simply print too much money, and at some point also a critical mass or a critical threshold of the population becomes aware of that, And that means that continuously loss of the confidence into these currencies, into these fiat currencies. And obviously with double-digit inflation numbers over the last few years, many people have realized that something is going wrong. And since there's no way out of this debt-based fiat money system, but printing more, the whole thing just accelerates. And the crack-up boom basically is a term to describe that you see, for example, stock markets going higher and higher while the real economy is actually not doing that well. You see real estate prices going higher and higher while in the end of the day, there is not necessarily real new demand, a new supply there's no real new demand for real estate. It's just that people trying to escape into hard assets and not keeping the money in the bank, in the currency in the bank, because it would lose purchasing power. So it's a terminology phrased by Ludwig von Mises 100 years ago, describing the hyperinflation in Germany. And it's obviously a long process. This is not something that happens overnight or within a few days or weeks. And it's step by step escalating and becoming faster and faster. And as I just said in the beginning, Germany, the German DAX just has a new all-time high, stock market high, while the economy is not doing well. Actually, we have a recession here. That is, for example, a clear example of a cracker boom where there's so much money printing, so much fiscal stimulus as well, while the real economic activity is not reflecting that.
Mm-hmm. Okay, yeah, thank you for that, because we're all experiencing that. So good just to put a definition to it. Expanded currency debasement creates a loss of trust in fiat money. People begin abandoning that fiat money for hard assets. And we're watching this from the central banks all the way down to retail investors, right? It's kind of full spectrum at this point. People are looking to put optionality into their savings accounts in whatever mechanism they can. So would you relate that? We talked about gold catching a nice rally right now, Bitcoin taking off as well. Those two things, how correlated are they in your view?
You mean gold and Bitcoin? How correlated they are?
No, sorry. I mean the rally in gold and Bitcoin on the sunset stages of this crack up boom.
Yeah, I mean, with my research and my company, we have been continuously over many years, even more than a decade, focusing on those two asset classes to escape exactly that scenario of a cracker boom and coming in the end of the day. The big final will always be a hyperinflation. We might be still 5 or 10 years away from that, but I focus on those two asset classes, and of course that the idea is that this is your safe haven, your escape, because neither Bitcoins nor gold can be printed out of thin air, and they're basically out of the traditional financial system. Of course, Bitcoin, I think, is still playing the arrival of the spot ETF. I think that is still what the market is pricing in. I was very optimistic and bullish in January of this year, and I thought we could go to 45 and 50,000, but I thought it would happen faster. It took now more than 12 months, and now over the last few days and weeks, there has been coming a bit more of a momentum into the Bitcoin price. I'm not such an enthusiast as I used to be when it comes to Bitcoin. But that's maybe a different topic. Of course, if this cracker boom continues, I think Bitcoin will be one of the fastest horses that you can bet on. But it's also a very speculative one and a very volatile one. And sitting through those 75% pullbacks, like we've seen in the last pullback in 2022, is tough and challenging for most investors. So it has to be only a small allocation. And gold, of course, is pushing higher. I mean, I've been writing about it that I expected the breakout, and it's been running against this 2075 all-time high now many times. And we have finally a new all-time high since as of Monday, early morning Asian trading session. However, it was kind of weird setup how it happened. And the background, I think, is, of course, part of this East against West conflict. You see the physical demand in Shanghai, in China, in India, in Asia, 73% of the physical demand coming out of the East, basically. While in the West, there is only paper trading gold happening, 200 ounces of paper gold for one physical real ounce. And that's how you figure out the price, right? I mean, it's a crazy setup, and it's going on for decades. And we've seen it very drastically in the last week of September, early October, during the Golden Week in China, when the Shanghai gold market was closed. And suddenly gold dropped $140 out of nowhere, basically, within 4 or 5 days. And then Hamas invaded Israel, and on Monday you had this big gap up when the Chinese came back into the physical market, right? So, and then gold took off, and we've seen this $340 rally within the last 2 months. I mean, it was a very big move in gold. So from that perspective, the pullback that we've seen on Monday from this new all-time high at $2,148 is justified and makes sense. Of course, profit taking, it was thin trading hours, early trading hours. So you can argue that, it's not necessarily massive manipulation, but in the end of the day, physical demand from Asia against paper trading in the West. And I think that also is very representative to what's going on between America and China in the big picture. So, of course, if you want to protect yourself against the cracker boom and reckless money printing, physical gold out of the system is a very clever, very simple, easy way to do. It has worked over the last 5,000 years, and I'm pretty sure it will work over the next few decades as well. It might not be the best of the best returns that you make with gold. I mean, Bitcoin obviously in the extreme phases will outperform gold, but it's a very easy asset to hold, in my opinion.
I've been a commodity investor for over 15 years, and I'm the host of one of the world's largest commodity investment conferences. I teach a 10-chapter course on commodity investing for beginners. No complex strategies, just actionable information. Our comprehensive course breaks down the complexities so you can make informed decisions and gain financial freedom. I'm Jay Martin, and this is the Commodity University. I want to follow the East versus West narrative with you a little bit, but before I get into that, I have to ask, so following this thesis of the crack up boom, driving interest in alternative asset classes with less counterparty risk, being gold and Bitcoin, it can't be ignored that while those two classes have been rallying, so has the S&P. And so the activity looks similar, but I would assume the motivations of the buyers are different because the fundamentals are extraordinarily different. But how do you see it, and how do you make sense of that?
Yeah, it's a good and valid point, because if you, for example, look at Venezuela, the stock market went through the roof when the inflation started to escalate, and during hyperinflation, I mean, you could make, I don't know how many million of percentage in nominal terms with the Venezuelan stock market, right? Of course, it has to be mentioned that the main drivers behind the stock market really are the Magnificent Seven and the AI boom. So it's not a very broad kind of stock market rally, which is generally a concern. Of course, you can also argue that, look, all the young kids are basically spending the whole day on YouTube, on TikTok, and a few other platforms that are basically driven mostly by those Magnificent Seven. So, yes, but then again, I think, and that's again part of the cracker boom theory, that stock market going through the roof, or at least rallying strongly, and most of the stocks are not participating. I don't think it's a very healthy picture. It has also to be mentioned that we have a lot of, probably now not so much anymore, but we had a lot of bears throughout the whole year. So many people recklessly tried to short the market. And that obviously drives prices also higher, right? I mean, they have to cover at some point. And that's, again, also part of the cracker boom, because it's just so illusionary. It doesn't fit together, and people feel like, yes, I have to short it because this thing will go down, but there's so much money printing, and then all the short sellers have to cover their shorts, and this all drives the prices higher. So I think when it comes to managing your investments and in the perspective of cracker boom, I like to have dividend stocks. Old school, traditional, boring dividend stocks that pay 5 to 10% just because you want to have a cash flow, and that can be even 10, 20% of your full net worth. I don't mind, as long as you have gold and Bitcoin in the mix as well. I think it's fine. I'm not a fan of all these tech stocks, but I might also be missing out something there. I mean, you cannot play all the sectors. But yes, I mean, the stock market is definitely also a way to protect yourself against the cracker boom, but you need to have the right stocks.
And so that's super key, because, and even as I ask the question, I'm acknowledging that, saying the market is up is a bit of a false statement. And as was pointed out to me, I was chatting with Chris McIntosh over at Capitalist Exploits last week, and he's like, Jay, people always make the mistake of calling it a stock market. Really, it's a market of stocks. And there's always opportunity within that market of stocks, but not everywhere. As you mentioned, yes, the S&P is up, but the Magnificent Seven now accounts for 25% of the S&P, which I don't think has ever occurred before, where it's been so consolidated and carried by the performance of so few companies. And it kind of strikes me as like a one falls, they all fall scenario, because if the market's so consolidated, 25% of the entire market carried by 7 stocks, and those 7 are leading this charge. Anyway, so then, within that, if you're looking at the market, you're looking for yield, you're looking for value, you're not looking for FOMO, you're not looking for hype and momentum necessarily. So getting back to the America versus China, the East versus West narrative, how would you frame the strength of the United States empire in this dynamic right now? It's been a common conversation on my channel recently. Are we in the sunset years of the American empire, or, are we just very quick to call the game early? And in fact, the American empire is still in its adolescence and about to enter the next stage of its global superpower. What's your take, Florian?
Well, that's a difficult question. If America would stick to its roots, which is free market and liberty and free speech and all these things that have made it so strong, I think there would be no competition at all. However, as we all know, unfortunately, this is not the direction America has been taken over the years, and I think looking at the population, it's. I mean, the only probably positive one I noticed that there's a lot of immigration and a lot of new, so to speak, hungry people coming into the country that want to build up a life and have a better condition for themselves. That might be something that will help. But other than that, the only real strength that America still has, besides having the largest financial markets, is its military. But I personally would hope that peace will prevail. I only see warmongers wherever you go, whether it's the Ukraine crisis or if it's the situation in Israel. Everywhere, I don't see any diplomacy. At least it seems that things calmed down a little bit a few weeks ago when Xi Jinping visited America, because I think next year will be elections and they don't need another conflict. So, but in the longer run, I don't see how this will play out peacefully. Behind the scenes, lots of stuff is going on already. I don't know. Again, I think if America returns to free market and free speech, yes, it will be and remain the strongest country and also will lead further into the 21st century. If it takes the other way, I think the Chinese know better how to run a dictatorship.
Yeah. Okay. Right. So That's an interesting point. The further the U.S. migrates towards authoritarian style leadership, eliminating free market, eliminating free speech, they enter an arena where they've got a competitor very versed in those things, very versed in dictator style leadership. That's an interesting take. So yeah, on the heels of Xi's visit to San Fran, do you perceive the tension between China and the U.S. escalating or de-escalating? Or do you have a take on maybe the significance of that visit and what lies ahead?
Yeah, it seemed like things have de-escalated a little bit. I mean, it's also important to note that the economic situation in China seems to be challenging now. I mean, they have for months and months already deflation, and they're having a tough time getting back on their feet after that implosion of the real estate bubble. Let's see. I mean, there can be certainly made some arguments for a case that China will become the next Japan, like Japan basically failed in the early 90s and never really recovered. But I think the circumstances are different, and China is much bigger. And obviously, if you look at all the critical resources, I mean, China has basically their hand on most of Africa already, intervening now wherever they can in a positive way, in a diplomatic way. So it's going to be very interesting from like studying it and observing it, but obviously it's also pretty dangerous, the whole thing. And part of it, of course, is the dollar, the petrodollar system, which, I mean, certainly on your show as well has been extensively discussed. I mean, the Saudis are now able to sell their gold against renminbi and their oil against renminbi in Shanghai and then exchange it into physical gold, even if they keep it in Shanghai for now. That's an alternative that the world hasn't seen for the last 50 years. The oil trade has definitely backed the whole dollar and over the years. So it's going to be very interesting how this plays out. And you see more and more countries coming to the forefront with lots of power, basically, and just moving away from America. So. And if I look here into the Eurozone, I mean, it doesn't feel that there are any good new ideas coming out of it. Germany is in a very, very challenging situation. And I don't know. I mean, unless there's a clear policy change, and even then, we all know that in the end of the day, it doesn't really bring a big change, new politicians. But I don't see a lot of good coming out of the West, honestly, at the moment. I personally continue to be very impressed by what some of the leaders in the Middle East are doing. As you remember, I mean, we last time we spoke, I was in Dubai, and I've been also visiting the Emirates and Saudi, and it looks like these are the only adults in the room at the moment. And they are really having a balanced view and trying to remain calm and peaceful and actually focusing on developing markets and less of a conflicting kind of party.
Yeah, interesting. You know, the China balance is very precarious, or it strikes me as such, because as you mentioned, they're experiencing some significant deflation, foreign direct investments now turned negative, significant debt and demographic challenges simultaneously have taken pseudo control of a lot of African resources, a lot of Eastern Russian resources, and that seems to be growing and completing international trade off the dollar now, increasing the influence of yuan, renminbi. And it makes sense because, if you're China, you're the world's largest customer of pretty much everything. And if you'll buy resources in yuan, well, there's an endless market of things that the seller of those resources who are receiving yuan can buy with yuan from China, being the world's manufacturer, right? And so it's an easy transaction. Whereas, not the same for obviously a country like India. They could offer to buy oil in rupees, but what are you going to do with rupees, right? It's not really a currency of high utility, whereas yuan is. And so, would you say, Florian, that this balance of power between the East and the West might come down to leadership? Is Is it more than the big trends of geopolitics right now? It's like the West lacks strong leaders who can unify people behind, a realistic vision, not a fallacy one. We've seen a lot of that. And there really are no strong leaders coming out of the West, whether North America, Europe, you name it. I don't see any, frankly. What's your take?
Yeah, it's very true. I think it will take a totally new generation at some point. And unfortunately there is this old but still very, very good saying that only hard times create strong characters, right?
Yeah.
And I'm afraid that we're not there yet. We haven't seen the real hard times in the West, unfortunately.
Not for a while.
We're on that track, certainly, but if you follow that saying, basically, then we're in for much harder times before some strong characters appear on the public scene. So that's a big problem. And generally, again, what I said before, we need free speech. We need free discussions. We need peaceful, respectful with each other. But we've seen actually quite the contrary wherever you go. Of course, here in Germany, it's the same situation like in America. The split between the parties, between people, between families, it's still there. It's not basically getting better, and most of the two parties don't want to talk with each other. So that certainly makes things even more difficult. And if you then look at what they're trying to implement, coming to the central bank digital currencies, all the things that they're going to track us, the digital. Basically, what the West now is also trying to do is tokenize everything, and it will be tokenizing yourself, your life, everything you did in your life, not only your assets, but basically everything, your past, your present, your future. And we're basically on a crazy way towards dystopian future here in the West as well. So it's kind of difficult to see how something good will play out of it. Obviously, I personally will assume that I will always find a way through this craziness. But it is what it is, right? And just can tell you, my health insurance is stressing me now. I think the 5th time that they're writing me, they want to have my digital. They want to create basically a digital folder with all this stuff for me. I don't want this. It's not your business. It's my own data. It doesn't belong there. And this is just one little live example that I can share here, where we will see that we become all digital slaves in the future. So, and in that kind of situation, it will be difficult to challenge on a global scale China, I think.
Interesting. Okay. So a couple of things there I want to pull on. We're beginning to paint a pretty dystopic future, and I think it's easy to make that argument because the data is kind of staring us in the face. It's really easy to paint a bearish picture of the future because the data supports it, right? Even if you're just looking at the U.S., you look at $32 trillion in debt, $2 trillion deficits. You look at, it's like endless data points, whereas the bullish sentiment is more like, we're best when we have our backs against the wall and we'll find a way forward. And it's kind of ambiguous, But we suffer from a term that Eric Prince coined called affluenza in the West. We've been affluent for a real long time, and we haven't had to struggle for a very long time. And so in that context, us moving towards from a unipolar world to a multipolar world where maybe there is global competition seems like it's going to get pretty dire. Things are very uncertain. Volatility increases. When in reality, multipolarity is kind of the mean, and we're maybe reverting to that. Until like 1991 and the fall of the Soviet Union, since then, there hasn't been a superpower in Europe, but that was the first time in 500 years that there wasn't a superpower in Europe. There's generally better power distribution around the world. So, and I would just say, as bleak of an outlook as we might be painting, I'm an optimist on human nature in general. Like I'm long human ingenuity and progress, but the long trend, the major trends, if you step back from like year over year, you look at decade over decade or century over century, our life tends to improve. The quality of life expectancy, access to clean water, all this stuff tends to improve. So long term, I am optimistic. Let's get to capital allocation right now, Florian, because that's where it gets true for me. It's like, let's speak with our wallets, vote with our wallets about where we think the world's going to go and how we're going to come out on top. So what does your portfolio look like right now? Where are you allocating cash? Where are you playing offense and where are you playing defense?
Yeah, just let me add one thing. I mean, I strongly believe in mind creates matter. Okay, so you really, as long as you stick with yourself and you have a clear goal and a vision and the courage and the discipline to follow through, you will figure out a way forward. But it has to be said that we are now really, I think, on a very critical edge here when it comes to mankind, because these dystopian tools with like the digital slavery that will be created at some point, there is no escape anymore, so that is serious stuff. So we're going to see how it plays out. Back to the capital allocation. So I strongly continue to believe physical gold should be one of the cornerstones of your wealth protection kind of part in your portfolio. So I think 10% is probably the minimum that one should have in physical gold at the moment. And I don't think that this will change anytime soon. And I would definitely not be willing to wait for better prices or maybe the market come back down or whatever. I think it's so stable. You just want to have it and you just don't care whether it's up 2, 3, 5% or down 5%. In the long run, it will be up. It will protect you. It will be outside the banking system. And maybe there's a time when you won't be able to get it anymore in your hands. So it's better to do it while available and while around $2,000. I think it's still okay to buy. Of course, it would have been better to buy much earlier, but some people have refused to look at gold. People who get gold obviously constantly buy more. So I think at least 10% of your net worth, of your total net worth, should be in gold. And if you want to have it a little bit more aggressive, you can obviously mix maybe one third silver and 2/3 gold. But you could also even go 2/3 silver, 1/3 gold. But this is then really an aggressive allocation. And as long as we're not really in that extreme cracked up hyperinflationary kind of setup, silver is always a challenging metal. It's such a small, tiny market, and it has these crazy moves to the upside, but also very much to the downside. And it's a byproduct of the copper production, of other mining production. So it's a very tricky market. There is a few hardcore silver bucks out there. I like to have it physically in my hand. I would not trade it. And it's up to you if you want to mix a little bit more or less. So the 10% should be the minimum. Preferably, I would even go to 25% physical precious metals of your total net worth. I don't mind. You can then add maybe another, in an extreme case, you could go 5 to 10% even with Bitcoin. However, you have to understand that Bitcoin is very volatile and you need to be basically a contrarian and very disciplined approach. You cannot buy Bitcoin at 50,000 and 60,000 and then sit through looking at it when it goes down to 15,000 and then hoping it will recover to 100,000 at some point. I mean, this is like crazy volatile, right? This is something for traders and people who really look at the market, but for somebody who doesn't want to spend too much time with their finances and have basically a buy and hold approach, it's a very challenging and tough asset. And again, also here, I would definitely say that it has to be in a cold wallet with your own keys. So that's another discussion we didn't yet open up, but obviously the Bitcoin ETF is not your wealth preservation, wealth protection asset. Not your keys, not your coins. So in this case, if you buy in Bitcoin ETF, you will not hold the real Bitcoins, but some form of a promise or a derivative of it.
You mentioned earlier that you're not as enthusiastic on Bitcoin as you used to be. Did I hear that correctly? And if so, explain that to me.
Yes. I mean, I think that there's so many reasons that I have to scale back on my enthusiasm. I mean, bought my first Bitcoin way below $100 more than 10 years ago, nearly 11 years ago, and I've been on the board for quite some while, and I think the most important thing that Bitcoin has achieved is that a generation of young people is aware of the problems in the fiat money system, and that's a beautiful thing. But so far it has failed in terms of really providing a payment alternative money system, basically. Yes, you can store and hodl and hide it away, but then again, it's already getting very complicated, and it's still very complicated. So your grandmother would not be able to like easily buy Bitcoin and store it on the ledger, and it won't change. And as I just said, if you go through an ETF, it's not your keys, not your coins. Suddenly, basically, what happens is that I think the big banks and wealth managers have realized we cannot stop the network, we cannot stop Bitcoin itself. And what you do if you cannot stop and fight against it, you embrace it. So they basically have embraced it. Maybe at some point, BlackRock will be the largest Bitcoin holder, and but they own the keys, they hold the keys, not the people who bought the ETF. Mm-hmm. And then they can do lots of stuff with it, as we know from the gold ETFs. I mean, probably one of the reasons why gold didn't come back above 2,000 in the last 12, 13 years is that there has been a lot of ETFs and derivatives built on top of it, which basically create an artificial supply constantly. And now it's the physical market in Shanghai who basically pushes gold higher. And it's a pretty similar scenario that I see for Bitcoin. Of course, initially, the demand with these Bitcoin ETFs will push prices much higher. But in the longer run, it's just a tool to basically hold prices down. And there's lots of problems in the blockchain and of Bitcoin itself. I mean, the ordinals constantly create congestion, for example, is very slow now. The key lead developers discussing to change the code, but we all assume that it's unchangeable. So it is changeable in the end of the day. So if we talk at some point about much higher significant prices, maybe there is some people having certain interests that will force changes at the code as well. Of course, it's still a network kind of question, but I also don't like the euphoria everywhere I go. So it's not a contrarian kind of thing anymore. And again, I mean, if you listen to all these Bitcoin freaks nowadays, I mean, they all have like the dollar signs in their eyes. And actually, I thought we want to go away from that. So it changed a lot. And I think for the original OG Bitcoin kind of guys, it's a little bit more questionable now what's going on. And obviously, it also has to be said very clearly that the noise from all these altcoins and scams and bad projects and fails, et cetera, over the last few years certainly have kind of like created a bad taste generally on the sector, which is not necessarily the fault of Bitcoin. But other than crazy speculation, I don't really see any progress over the years, to be very honest.
Yeah, that's an interesting point. So, you know, the promise that was once there hasn't necessarily materialized in that it never, or it hasn't yet actually become the tool of transaction that was maybe the hope. And the biggest gain from Bitcoin thus far might be the philosophical understanding of money, right? In that generation of that younger generation of Bitcoin investors. You know, I see it similarly, Florian. Like my bet on Bitcoin is kind of a bet on demographics, because if you were to draw like, you know, division lines between investors who want nothing to do with Bitcoin, investors who are open to it, like 5-10% of their portfolio, and then those that are just sort of all in, it's age, typically it's generation, you know? And so, you know, I look at that and I'm like, those who are very unsure about a digital currency will continue to age out. The next generation, like my kids, I got 3 boys under 10 years old. They're never going to think twice about digital currencies. I mean, they're digital natives. They will grow up in a digitized world, full stop. And so there will not be that foreign nature of like, but what is the intrinsic value of a digital currency? I don't know that they'll ask those questions. I mean, I'm going to do my best to make sure they understand the value of hard money. And they've seen my gold coins, and we talk about it. Actually, it's kind of fun. But we have those conversations. Interesting that, so you see the ETF as potentially a tool to control price. Did I understand that part correctly? Yeah.
Yeah. Yes,
okay.
For sure.
Okay, interesting.
It's legitimate. I mean, they of course want to make money as well, and if there is a huge demand for it, of course they bring an ETF to the market. Yeah. That's also a way to explain it or understand it or look at it. But again, like learning from the gold market, we have seen that. I mean, once gold topped out in 2011, the gold ETFs. People who would have bought physical gold would have not been able to just sell on a mouse click whenever they feel bad. That's actually the second big mantra in the Bitcoin space, HODL, right? Hold on to be alive. That's what initially was somebody misspelling the word hold. And with an ETF, you throw it out whenever you want very quickly. You don't mind. And it can obviously create huge supply at certain points in the market. When the market tops out, breaks, whatever. And gold back then in 2011, I think fell nearly 50%, and nearly all the ETFs completely sold their gold. So it's a questionable kind of thing. And again, I always thought that we wanted to revolutionize the money system, and now it's going to be part of it. And I understand that if hedge funds and banks want to invest in this, they need to have a proper way to do it. And it's not possible by buying the stuff and putting it on a cold wallet in a ledger. I totally get that. But again, I think the initial idea has been perverted.
Yeah, you made an interesting comment that just got my head spinning about the inability to, mouse click sell your physical gold, and how valuable that slow money is, and how our obsession with fast is often to our own detriment, whether it's like fast money, fast food, you name it. Like often these things don't serve our long-term interest. And the benefit of slow money is that it forces you to think through your decisions a lot more critically, right? Because you have to sleep on it. And I walked my audience through a real estate transaction I did last year where I had this opportunity to close in a very expeditious nature on a piece of property. And I was squeezed on liquidity, and I liquidated some of my gold, got the cash, closed on the property, wrote myself a promissory note that the ounces had to be paid back by the end of the year, in addition to a fee of ounces. So the loan terms were in ounces, not dollars. We facilitated this, I borrowed from the bank of Jay, bought the real estate, paid back all this stuff. But the interesting point to me was like, friends were like, well, if you had just held your savings in cash, you wouldn't have had to go through this arduous process of selling your physical gold, getting the cash, closing the transaction. And I was like, yeah, that's the point. Those guardrails are really important, right? That slows me down. Somebody who is super trigger happy like myself, it's actually beneficial to have slow money. Right? That's an interesting point.
I think it's a very important point. I can just agree and confirm this from myself as well. I mean, my physical stack has always been very, very good to be there and helpful in certain types. And before selling any of that, I have actually spent a lot of time thinking about it.
You should.
I always made sure to replenish it and then buy even more in the situations, right? So it's definitely changing things, and two important mantras: not your keys, not your coins, and HODL. And those two are basically perverted with the Bitcoin ETF.
Okay, got it. All right, so up to 10% precious metals, weighting maybe 2/3 gold, 1/3 silver, but really like your own preference there. You're cool going up to 25% precious metals. 5 to 10% Bitcoin. Where else? What else would we find in your portfolio today?
Well, I think 30% is real estate, personally, and the portfolios that I help with and consult with are, of course, not having any real estate inside, but we play, as I said before, the dividend stocks. So that's a little bit, also again, a little bit more of a slow kind of money approach. So,
in any industries that you're looking for, if you're looking for yield paying equities, are you looking at certain sectors, or where are you looking?
No, I'm pretty much agnostic when it comes to that. Of course, bearing in mind that the big picture, east-west, what we talked about. So I still assume that we are in a commodity super cycle. So I probably have a bit more of a commodity exposure in the portfolio than most other who try to build a dividend portfolio. That means, for example, exposure to energy, oil and gas. And that means also to mining via BHP Billiton and Rio Tinto. So it's not financial advice here, but I believe those two are great companies for just creating a cash flow. Every year, I think, paying 2 times a year. Some even pay quarterly. So that's nice, and that actually creates a different mindset also, that constantly money is coming in, like your focus shifts, and even in those challenging times, you suddenly see like there's constantly money coming in and not going out. So that's very good. Coming back to mind creates matter, right? You wanna basically move in that type of energy through your life, and so that's at least the 25%, and there's also a part where we play the gold mining stocks, of course, because that's what I'm doing for years. And that again is a very individual kind of question, how much you want to expose to this very volatile and challenging sector, but it can be, of course, very rewardful at some point. So I have not touched any small exploration developer kind of stocks in the last 2-3 years, but I've been very optimistic a few weeks ago now that the mining stocks probably will have a good few months ahead. So I'm interested in the small to mid-scale kind of producers at the moment, because I believe if gold continues to move higher, that's where the margins basically kick in. That's where the balance sheets really look nice at a higher gold price. And the risky, speculative, small juniors, exploration kind of stocks, they come later in the cycle where we are not at the moment. So right now, gold is fighting with this breakout. We had the monthly close end of November above $2,000, which I think is an important signal. We had a new all-time high on Monday. I thought, basically, I expected some kind of development like we've seen, but I didn't expect it to be happening in a few hours. I thought it would take at least 2 weeks to play out. So now it has to hold above 2,000 and then maybe try again to break out above this former all-time high at 2,075. And then I think at some point the mining stocks will kick in. And so you want to have this exposure. And yes, the smaller Canadian exploration companies can go 10, 50x, whatever they can. They will probably in the end of the day, if we look back in a few years, but it's going to be a crazy roller coaster. And it's a very speculative part of the portfolio. And right now, I don't feel like I need to be part of that. But certainly once the Fed will start lowering interest rates again at some point over the next 3 months to 2 years, I think that these mining stocks will be very interesting. So I'm constantly screening those kind of stocks, but I'm not willing to deploy capital at the moment at this risky part of the mining stock sector. I rather stick with the small and mid producers.
Well, because great, and I totally agree with you, because you can right now. You can buy gold producing, healthy balance sheet companies at crazy cheap valuations, especially relative to their prices only 2.5 years ago. And there's a reason that I love that. But first, just it's a very balanced portfolio, Florian. You've got your sort of barbell approach here, where you've got your safe haven, non-correlate asset classes, low counterparty risk, your gold, your Bitcoin over on one end, and you're quite heavy there. You have your yield generating positions, because the impact that incoming cash flow has on your mindset, is very impactful. I love that you mentioned that, like, and just how it probably shifts your decision making on a day to day, because it's a bit of an insurance policy and some diversity of cash flow and all this stuff. It's funny how frequently people ask me about, where should I park some cash, or what stocks should I look at, and all this stuff. And after we dig into their picture a little bit, it's like, you don't have an investment problem. You have a cash flow problem. You don't need to pick the winning stock. You need to fix your cash flow problem right now. And so, addressing that with your portfolio as well, super, super valuable. And then on the equities front, like just, buying gold stocks, I completely agree. You don't have to go to the super sketchy speculative stuff that may deliver the 5 to 20 bagger, but comes with crazy risk and probably a lot of time right now. Whereas you can walk into these mid-tier producers and scoop them up at present for pennies on the dollar. And that game won't last, right? If the gold price continues to rally, like, we know what's going to happen. It's the same thing that happens every single time. The underlying commodity price rockets, the equities follow suit a few months later. So very interesting. Okay, so look, I want to thank you for chatting with me today and coming on the show and sharing your outlook, sharing your portfolio allocation, where you're putting cash and why. Anywhere we can point people today who want to hear more from you, Florian?
Sure. Yeah. Thanks for having me, Jay. People can go to Midas Touch Consulting.com. That's our website. And we also have a free Telegram channel, Midas Touch Consulting, where lots of people from all over the world meet and talk about gold, silver, mining stocks, commodities, and Bitcoin and cryptos. It's kind of a mastermind group. It's free. Just join us. Everybody's behaving well and respectfully. So, yeah, that's the place to.
All right. Yeah. Midas Touch Consulting.com and also at Florian Grummes on Twitter. It's in the handle there. Look, thanks so much for joining me today. It's always great catching up with you, Florian.
Thank you. Thanks for having me, Jay.
Commodity investing for beginners. No complex strategies, just actionable information. Our comprehensive course breaks down the complexities so you can make informed decisions and gain financial freedom.